every time I intervene in the portfolio, I'm going to be paying transaction costs of one form or another. And I need to ask myself, how likely is it that the intervention that I'm going to make is going to outweigh this basic principle that a few winners are going to carry the portfolio forward? And I think that the odds are against you. You may not take the path that has the highest expected outcome, because if you get that improbable but possible, very negative outcome that's unrecoverable, you don't want to live that path. When we change our mind, that means we're alive, we're growing, we're thinking.
You're watching Excess Returns. I'm Matt Zeigler, joined today by the wonderful host of Talking Billions. Goodness gracious. Sweaty balls of fire. I have to get it in here in the NPR voice. Did you see that in the comments last time, Bogumil? People are loving the Bogumil voice. Just a commenting on.
Nice to see you, Matt. I was looking forward to this.
We're talking about Guy Spier. We've got a bunch of Guy Spier clips queued up. Excess Returns has interviewed him. Talking Billions has interviewed him multiple times. You actually kind of know Guy a little bit.
I met him and I was thinking, I think over 10 years ago, it was at his investor meeting in New York. It was a hot day. It wasn't summer yet. I think it was May. I remember it was really hot and I got to meet him in person. I read his book, which I highly recommend, The Education of a Value Investor. I'm sure we're going to talk about it. And then I saw him a couple of times in Switzerland and I got to visit his office. And at some point I had him on the show. And I'm going to save it until the end, the story of how he invited me to the Value X in clusters.
Okay, save it for the end. I can't wait to hear that story because I don't know this story. You got me holding off to the end. All right, so we got a bunch of clips. We're going to play them. We're going to comment on them. We're starting right here. Producer Jack, let's run this first clip. This is about holding on to your winners.
Yeah, it's a really powerful idea, and I get the opportunity here to debunk and correct a mistake that I've made elsewhere. So in the past, talking about this idea, I've cited a study that doesn't exist. And it's a kind of a story that gets repeated. It's a study supposedly that was done at Fidelity in which they looked at dead people's portfolios and they discovered that dead people's portfolios did better than live people because dead people didn't rebalance and do all of those things. So then, I say this somewhere, and this is a great advantage of learning public. Somebody writes to me and says, that is not a true story. I'm like, really? I've heard it so many times. They say, yeah, it's it's old wives' tale, something like that. It's scary. So Robert Shiller is a professor at Harvard University, and he has talked about narrative economics. And what he talks about there is how stories can have a viral aspect to them, and stories that are not even true can have a viral aspect to them. So why am I bringing that up? Because I just want to debunk that is not a true story. But the basic principle encapsulated in that story, in this case, happens to be true, I believe, or I can think is provably true, is that if you take a random portfolio and hold it for a very long time, take out of X stocks in the S&P, take a random 20 names, allocate 5% of your theoretical portfolio to them, and then hold them for a very long time, you'll get some big winners, you'll get a lot of things that do nothing, and then you'll get some big losers. And the majority of your returns will result from your big winners. And the question that arises, if that is the case in a passive portfolio that is selected once, every time I intervene in the portfolio, I'm going to be paying transaction costs of one form or another. And I need to ask myself, how likely is it that the intervention that I'm going to make is going to outweigh this basic principle that a few winners are going to carry the portfolio forward? And I think that the odds are against you. You need to see overwhelming odds to make a move. Then you might have overwhelming odds. You might have clear evidence that a company is about to go bankrupt. You should take every single penny off the table. But the standard for behaving needs to be very, very high. It needs to be more than just I'm rebalancing my portfolio, in my humble opinion. Another idea there that is really fascinating, and forgive me if you and or your listeners' audience don't know Berkshire Hathaway as well as I do, but Berkshire Hathaway is well known for being this conglomerate that has all these different businesses in it. But actually the companies that carry the vast majority of the intrinsic value of Berkshire Hathaway a small proportion of the total numbers of businesses that Berkshire Hathaway has bought. So the same principle applies within Berkshire Hathaway, probably implies within many different businesses. So it's just, the principle, if I just pause and self-reflect, that principle that I'm enunciating is very simple to talk about and demonstrate. Far more difficult is to actually act in such a way that you don't rebalance the portfolio, because it can be painful. You see a stock go up 5 times, and then it goes down by 50%, and it's like, shoot, that's painful. Actually, how many charts have we looked at of companies from this most recent era that went up 10, 20, 100 times, and now they're down 90%, and guess what? They ain't ever going back. So which one of them do I own?
All right, Bogumil, you big Eddie Money fan? Or was it 38 Special? Who sang Hold On Loosely? Big fan of, the song? Hold on loosely, but don't let go.
There is a quote, I think it's Buffett's, about holding your convictions, like strong convictions, but held loosely, that you can let go of them if you have to. I think he said that.
It fits. He did. Yeah. Strong convictions loosely held. And I feel like a bunch of people have said this, but I parrot this all the time. My first big one with this, I loved, and I learned this from Guy Spier. I don't know why he was the person to break this news to me, that Fidelity study was fake.
But then he adds that although it might have been fake, the principle behind it is true. And then he points out that, we learn things through stories. And I remember when Robert Shiller wrote that book that he talks about, and I was actually at an event where he was giving a talk about that book, The Narratives. It was a few years before COVID. But anyways, the big point is that we find those companies now and then that make a huge difference. And I have this idea that a lot of people find the right stock for the right reasons and even buy it at the right time. But very, very few have held it long enough to truly matter and make a difference. Only this week, I spoke to somebody, I hope he doesn't mind that I'll mention it, that has held Berkshire Hathaway shares since the 1970s, which is very, very impressive. And he not only found the right thing, he had very little understanding of what he bought, but he grew to appreciate it. It's no recommendation. Everybody has to do their research. But Berkshire Hathaway proved to be this miraculous, almost compounder of wealth under Buffett's and Munger's leadership for more than half a century.
It's absolutely incredible. I think about this a lot in terms too, and I know we're going to talk about both the pieces of business and being business owners, but I think about this with people in jobs, and especially business owners, and especially people who are builders of, multi-generational family wealth. It's like they have the stock portfolio. They might even have some of the other stuff, but it's that business that was at the core that threw off all the money, that did all the great things. Like that's a version of letting the winners run.
Very much so. When you talk about families, and you know that I work with families with multi-generational fortunes, when you go back far enough, it was usually a single business that created the wealth. Not always, but often enough. In many cases, it was also acquisition of wealth throughout a lifetime, and that's usually for a portfolio. But at some point, they part with that business. The industry changes. The family doesn't want to be involved in many reasons. But eventually, that wealth turns into a portfolio of businesses. When I think of that family, they have an infinite investment horizon. They're no longer managing this money just for you and I, for our lifetime. But they really, really look far ahead. They're managing it for their kids and grandkids and great-grandkids. And I got to meet families that have had substantial wealth for a century or more. One family I interacted with, if I remember right, the initial seed, the initial capital was made when Beethoven was writing his symphonies. And from many connections, many families, that wealth in many ways, that thread through history continues to today, which is really, really impressive and makes you pause when you sit in the room and ponder for a minute. What kind of money are we talking about?
Seriously, here I am with 38 Special references, and you're bringing, the god Beethoven into the situation, to the thing. Well, one other thing I have to ask you with this one too, because I think it's embedded in this, is that every time you start to change with it, every time you start to tinker with those winners, you incur costs. And I think about it in this sense too. If the family has the business in the infinite time horizon with what they've made, like you try to sell that business, you got the investment bankers or whoever else are coming in to chop it up. Like This costs metaphor that he used, this really caught me, the way he said it. How do you think about this?
Well, the cost and the fact that you try to tinker with it. And you and I spoke with Chris Mayer, and he has so many important ideas, but one of them is that for a long-term shareholder of a successful business, one or many, the hardest time is not the drawdown, but it's the dead money period. And even Berkshire, since we brought it up as a case study, had many years, I think at some point 7 or 8 or 9 years, when the stock went nowhere. It's very, very hard if you're managing your own money, other people's money, your family money. When you're looking at your portfolio and you have anything there that has done nothing for you for close to a decade, it's very easy to say, I'm going to replace it with the next thing that I'm more excited about. And I think that's what Guy is talking about, that it's so easy to remove those long-term winners. And Chris has done remarkable research, Chris Mayer, showing how companies that went up 100x, they had very long periods of just going nowhere. And you had to hold on to them and believe that they will perform over the long run. I'm going to bring up briefly, the study, the Fidelity study might be not true, but there's another research piece by Robert Kirby about the coffee can portfolio. Mm-hmm. He was managing money. People can look it up. And there were 2 clients, well, one real client, the wife, and the husband, or the other way around, I don't remember. But one of them was buying and never selling the stocks that were bought in the other portfolio. At the end of the day, it became this coffee can portfolio where some of the stocks were really, really big positions and some of them were tiny. But the idea was that whoever was making the decisions was making a single decision, buy and never sell, because you're never sure which one is the ultimate winner.
There's powerful stuff in there. All right, we're rolling on to that next clip. This is good. This is Guy explaining this idea of losing it all.
The first statement that comes to my mind is, I think it's a famous one from Warren Buffett, is it's a very dumb idea to risk what you have and you need for what you don't have and what you don't need. I think secondly, of friends and colleagues in the investment business who will accuse somebody like me of being in the stay rich business rather than in the get rich business. I mean, Warren and Charlie have said that they wouldn't really like to start again. Yes. They're very glad that they are where they are. And I think that to be forced to start again or to lose it all is the ultimate definition of failure. I mean, you cannot get a better definition. I mean, you're there to preserve and grow wealth. It would seem to me to be one of the number one priorities of somebody who's in wealth management, and so if you lose it all, you're done. you kind of failed in the most profound way possible. How can you earn a living? You can earn a living out of your labor. That's what the vast majority of humans do. And there's a very small proportion of us who are extraordinarily privileged to be able to pay our life through leveraging. If you manage to run a law firm or an advertising firm, you're leveraging off other people's labor. And if you're extraordinarily fortunate, you can leverage yourself off capital. If you lose the capital, you can't do that anymore. You got to go back to, selling your time. That is an outcome to be avoided at all costs. That's the name of the game. How one does that, and B, what psychology does one need to get, and what do we need to do in order to get there, and how much of it can you learn or create for yourself, and how much of it is just innate is a great question. Some of the world's smartest, most sophisticated people have gambled it all away. Sam Bankman-Fried is the one that comes to mind right now, but we just have to think of LTCM, long-term capital management. They did the same thing. I think that we all discover stories. I mean, an interesting, in terms of losing it all, an interesting criteria, it was quite morbid actually, but how many suicides have you had? So in the 2008-9 financial crisis, there was a period when people threw themselves out of buildings. You can imagine that they were in a position where they kind of like had lost it all. And rather than start from scratch, they decided to end their lives. And I've understood there's been either people being pushed out of windows or people throwing themselves out of windows around coin Sam Bankman-Fried FTX today. So I think that this question has some parts.
Okay, I'm profoundly moved by this idea of it's a dumb idea to risk what you have and you need for what you don't have and you don't need. I know we shamefully missed each other narrowly in Chicago the other week. I have to ask the question, have you ever had a Rico Benny's sandwich? Are you familiar with the Rico Benny's?
I am not. What is it?
I feel like you're a more health conscious person than I am, or you hate your stomach less than I do. The Rico Benny sandwich, and if we'll see, maybe Jack will put a picture up in here for. I'll send my picture of it in. We'll see if we can post it on the screen so you can see the disaster that is this sandwich. So years ago, I saw Anthony Bourdain interview Steve Albini, and they go to Rico Benny's, and that's where they eat. And it's basically it's a true working man sandwich. It's basically fried steak with effectively the sauce you would put on a deep dish pizza. So like like a heavy marinara, and then like shredded mozzarella, but like you took 6 polio string cheese things and just peeled it off. So it almost looks like spaghetti on top of this fried steak covered sandwich. And then there's hot giardiniera all spread through it. And it's on a bun. You eat this sandwich, you literally need to take a shower or wash your arms up to your elbows afterwards. It's the messiest thing I've ever eaten in my life. I will be aching and yearning for that sandwich, which, to be very clear, this is the joy of what you don't have and you don't need, but you still want. And if it doesn't kill you, it gives you a great story.
I love that clip. I enjoy your story. I might look into that sandwich when I'm back in Chicago. It's a question that I asked him too at some point, and he introduced me to Luca Delana, who I had on the show multiple times, and you know Luca too. And it's impossible to share with the audience everything that Luca is about, so I highly recommend looking up his work and his books, and he wrote many. But the big idea, he says to us that Luca does, it's not the fastest skier that wins the competition, but the one that participates in all the races and is the fastest at the end of the day. And it's very important when you think of wealth and risk. And risk is a concept that somehow is very hard to grasp because there are so many risks we take and we don't even know. We're underwriting so much risk sometimes. And Guy's big point, and I had many off-the-record conversations with him about it as well, that there are certain scenarios that could lead to a total wipeout, which is a skier that breaks a leg and he or she just cannot participate anymore, right? So what you really want is, yes, you optimize for a certain return and compounding over time, but what you don't want is as important in investing or in life in general, right? When you engage in an activity that could totally take you out of the pursuit, the race, the competition, and in this case, compounding. And he brings up a couple of stories, but I like that idea that Charlie and Warren share that they would never want to start all over again. You know, compounding as such is such a painstaking process. In the first 5-10 years, you hardly see the result. I mean, it's growing, but it's still nothing with what it can do compared to what it can do over the next few decades. You don't want to start with a tiny snowball all over again.
This idea of, and you're skating around this and you're bringing this up in my mind, of when we own businesses, when we own stocks, when we own equities, we always talk about thinking like a business owner, remembering you're an owner in a fractional share of this larger business. And that's different from being, whether it's in our own lives or if we literally have a business that we own where we are the business owner. And it's part of our job with this risk and losing it all, and Buffett and Munger not wanting to go back to ground zero. It's like, if I'm taking all the risk, if it's all concentrated on the one thing, then I can lose it all. If it's just my business, I'm thinking that way. But now I'm constantly taking pieces away from this business. I'm constantly taking distributions or dividends out or things where I go, I can't put this capital back to work in this same vehicle. And now I want to become a smaller owner in all these other businesses. I still want to think that way. The mentality and the storytelling is still there. But now as a fractional owner in a group of other businesses, I've shifted the risk. I've shifted the thoughts on this. And even, how do you think about it with Charlie and Warren and what they built with Berkshire Hathaway? How do you think about that idea of like, we still own Berkshire, we don't want to go back to risking it all, but we own this business, but we actually own all these other like mini businesses?
You're making a fascinating point. So when you look at the business, and I think the other concept here is diversifying, right? So how do we diversify? And you could own one single business, but that single business is in, let's say, 150 countries. Let's say it has 10 different product lines. On top of it, it might have services, some recurring revenue, subscriptions, whatever it is, maintenance. In some businesses, you sell something, you do a lot of maintenance that follows up. So you really don't have one single thing. You have many different things in many different markets. If one market, for whatever reason, goes south and you can't do business there anymore, Venezuela was a good example. A lot of companies lost their presence and assets in that country. you can continue and you can go on. So that's one thing that I want to mention. The other thing I want to mention, I have this rule of not having zeros in my portfolio. And we may come up later in the conversation too, but I have this idea that if I find an investment idea and I can imagine that idea going to zero, I don't want it in the portfolio. And over the years, and I've been doing this for 20 years, I realized that there are 3 buckets, so to speak, that can get me to zero. One is the secular decline. This business is going to get smaller and worse and weaker, right? The second one is management. And they don't have to be fraudsters, but questionable management doing questionable things that are maybe within the lines, but it's not what I would like to see happen as a shareholder. And the last one and big one is too much debt. And I mentioned it to you in one of our recordings, how a business that has too much debt can go bankrupt. A business with no debt can stop operating only when the last customer decides not to show up. It's such a powerful idea to me. So you might have a great business doing the right things, but you have so much debt. You have a little dip in the economy or in your sector, and you can't pay interest on your debt, and you can get closer and closer to a bankruptcy. You don't want that to happen. That's the scenario that Guy is talking about, among others, where you just don't want to play too close to just falling off the edge and no longer participating.
It's so important to think about this at all these layers. All right, we're going to keep rolling here. Circle of competence. We've all heard the expression. Nobody explains it like Guy Spier.
Everybody says having a well-defined circle of competence. And how do you decide that something in your circle of competence or not, And you buy something, I buy something, I think this is totally in my circle of competence, and then it goes down by an endless amount. And I say, well, is it actually in my circle of competence, I think that it's really, really hard. And we live in an uncertain world. We have far less than full information. We're getting samples of the data that's out there. And somehow we have to both make decisions on the portfolio that we manage, and we have to update the models of the world in which we live. And I don't have any easy or good answers to that. I think that keeping a diary, so writing stuff down so that we can remember who we were then, is helpful. I think that, I'm going to try and share something with you now that when I try and share it with my CFO, he kind of like, he rolls his eyes. But it's a really powerful idea. And if you know, what's his first name?
Michael Mobison.
Michael, forgive me. You're a huge figure in my life. I should know your first name. So there's a guy called Ole Peters, who's also part of the Santa Fe Institute. And he's written about an idea called ergodicity. And I'm going to try and explain how it applies to investing. And if I could divide myself up into, any one of us could divide ourselves up into, 1,000 different versions of myself. And now we could kind of like follow through what happens to my portfolio in each one of those. And I get the aggregate of all of those 1,000 different versions of myself 20 years on. I can expect some kind of an outcome based on what kind of risks and decisions I make. But I cannot do that. I cannot divide myself into 1,000 different versions of myself. I have to take one path through the future, and I can only pick one of those paths. And out of a certain kind of behavior, you can have a very broad distribution of outcomes for those 1,000 different versions of yourself, where if you average them out at the end, you'll do fine. But imagine that we're talking about Russian roulette, or no, let's take another example. Let's just say that I'm a guy who's playing the odds on a roulette table, but in this roulette disc, the odds are slightly in my favor, but only slightly in my favor. That might be a game that in 55% of the outcomes I win huge, but in 20% out of the outcomes I go bankrupt. And that's, so on the average, I'll do great. But I have 20% of the outcomes where I actually lose everything. And that's just not an acceptable outcome. That is not, so what is my point? We have to look at our lives. We have to be careful to realize that we are not the average of all the possible outcomes of the expected value, because there are outcomes of how we behave with our portfolio that could take us to zero, and then there's no recovery, and then we don't get the benefit of all those positive outcomes. I don't know if I'm making any sense. What's my point? When we're deciding what's our circle of competence, when we're deciding our investments, I think that to be aware of the idea that there's no recovery, for example, from a complete loss. If you have a very significant loss, the ability to climb back from that is increasingly difficult. So you may not take the path that has the highest expected outcome, because if you get that improbable but possible, very negative outcome that's unrecoverable, you don't want to live that path. So you need to cut that path out by having a different strategy, if you like. So in terms of circle of competence, you kind of like, and just to try and actually answer your question rather than just ramble, it's trying to figure out, how do I decide my circle of competence in such a way that I rule out those versions of the world or those versions of me that will hit rock bottom.
Keeping a diary and writing it down has to just be one of the most obvious things. And Chris Mayer, who we both love his work on this stuff too, the time binding stuff, and just this practice of going, who am I in this moment right now? How can I reflect as myself in this moment right now to understand how I in this moment thought about this thing? Because I might be right or wrong later, but having some way to look back on this and say, oh, here's what I missed, but also here's why I missed it, and to be kind of kind to that past self, but also learn some lessons. This circle of competence is a constant redrawing of what do I think I know now, and you need a method to reflect back on it. I know I have a different non-finance version I do with my personal archive stuff. How do you do this professionally? How do you do this at work?
I have this image that somebody introduced me to, how when your circle of competence grows, the circle gets bigger, right? So you're touching so much more than you ever touched before that you don't know. And I think it's very humbling as an investor and as somebody that pursues knowledge in general, to acknowledge that there's so much that you don't know. And to Guy's point, you think you know until the stock starts to go down and you start to question if you're right about it. And I like this idea of being the least wrong. What can I do to be the least wrong? And I think it's a much healthier approach, at least for me, to get into investing and managing other people's money. A lot of people might get into investing thinking, I have to be right. I'm going to prove to everyone that I'm right. I think it's a dangerous territory. Things change, businesses change, regulations change, governments change, and everything else, consumer preferences change. For you to say that you know something for sure, I think it's a dangerous proposition.
So my metaphor for this, and now I think I need to write a post about this because you didn't everything in mind. If you have your circle of competence, and the idea of like where you're sure, I don't know, the triangle of incompetence, I feel like that's the shape. You can always draw a triangle, unlike a square. It could be a weird isosceles, John, or whatever else. But you're right. It's where you're trying to force your awareness, your knowledge, whatever, onto that thing. That's the danger zone, when you're not leaving enough room for, these are the aspects of this that I can't know. I'm not going to put any hard corners on this thing. I'm going to let the circle be there. That's the best approach you can take.
He also touches on what you don't know, or what you think you know but isn't so, which is a dangerous territory. And he brings it back to the risk equation that we talked about before. And I like this idea. I like it. I acknowledge it, that there are certain risks that even the richest cannot afford to take. And it's such a powerful revelation to me. When you're thinking about an investment portfolio as such, or an individual idea, there might be something that you don't know, or what you think you know is not correct, or it's about to change, or it will change throughout the period when you're holding the stock. So considering that, and he talks about 100,000 versions of himself in aggregate, he might be fine, but there might be one roulette moment when he's not fine. When you don't know, or if you got it wrong, what are the consequences? I think it's a worthwhile question to ask.
Plays back to the Luca Delana stuff too, doesn't it?
Yes.
Like
yes.
this is just ergodicity all the way down.
It's
You
all
gotta know
connected.
this stuff. It's all connected. All right. Well, from my triangle of incompetence onto the next clip. This one is about his definition of success, which, hey, this is a favorite question of yours. You're going to tell us about it in a minute.
It's definitely not a number, a financial number. And I think I differ from a number of people I know in that regard. So first of all, I think that many people, so in New York City, investment bankers talk about their number. It's the number of dollars that you can kind of retire and afford to live the life that you want to live. I remember when I was young, my father used to say to me, "You're rich if you can live off the interest of the interest." It was kind of a term that he used, which was an interesting idea. I remember being at age about 25 and saying to a good friend of mine who actually lives in Paris, that if I could be entrusted with $100 million at the time, I said to him like this, which I think is an interesting way of looking at it. If $100 million if I'm trusted by $100 million of wealth, those people are not going to argue with where I send my children to school, what vacations I take, and what kind of home I live in. So the basic circumstances of my life are going to be as good as you can have effectively. And I think that's probably about approximately the kind of AUM that an investor needs. It doesn't even have to be theirs to achieve 99% of what they need, or 100% really of what they need materially. I got to that place, and that was an interesting perspective for me. And so now what happened to me is that, and it happens to people around my age, I think, so suddenly you realize the limited resource is time, not money. What do I want to fill my time with? I got to a place where I don't want to say change careers, if you like, because I think that basically I enjoy what I do every day. I think that I love living in a world of ideas. I love thinking about things. I love reading and learning. And I'm in an environment where I can read and learn. The more I can do that, the better. I'm in a good place there. I think that what highly motivates me is an idea that, that some famous very rich guy died. This is a story told, of course, by Warren Buffett. It's all told by Warren Buffett. So many people came to his funeral. Only thing is that they came in order to see that he was really dead. That's how many enemies that person had. And before we go into the implications of those stories, the other one is that a very, very rich guy died. Do you know how much wealth he left behind? And the person asked, well, how much? And the person said, all of it, so you leave all of it behind. I think that to get to whatever the destination is with a group of friends who really value you, who are grateful that you're on the planet, who are grateful that you exist in their lives, is something that is certainly a target for me. I don't want to die with no friends. I don't want to die with few friends. I want to die with many people who say it's great that he lived the life that he lived. He made a contribution. He was such a positive part of so many people's lives, I think is a good way to think about it. It used to be that at the end of every year, I had a spreadsheet where I'd track my net worth. I'd track family net worth. I stopped doing that about 5 years ago, and I don't think that's the measure. And another very interesting measure of success, and by the way, how do you fill your time? And so in addition, reading and learning and thinking through interesting ideas and problems, not necessarily just investment related, is something that clearly I love spending my time doing. I do enjoy sports an awful lot, and I like being outdoors an awful lot. And so I am happiest when I have a significant amount of time doing that. Just come to the end of a period where I've been away from my wife for 10 days and it's been miserable for me. So I really, really value the companionship of family and people who value me, not because I'm a business person or that because I'm an investor, but because I'm a person who loves them as family members, not as something else. So I think that those are key ingredients. I don't know them personally, but I've read plenty of stories about people who were super wealthy and had no friends and no family, and that sounds utterly miserable. And
it's not a financial thing. It's such a life thing. Tell me for a second, Bogumil, you've been asking this question for a hot second on Talking Billions.
Yeah.
Where did the idea come from to just ask this question?
I ask myself a lot how I think about success, and maybe we'll get to it in this conversation. But I wanted to know, I see these conversations as a chance to get to know the real person behind the newsletter, the book, the image, the legend that we know. And I'd like to understand why you're doing what you're doing, which is something that I usually find in the early days. That's why I start the conversations with, tell me about your childhood, if people are open to it. And some are really open and tell me stories that bring tears to their eyes and definitely to my eyes. And then at the end, I'm asking them, where are we going? Where are you going, right? And to me, success, for lack of a better word, is that goalpost. It's it keeps on moving, but at least where are you going with that, right? And I love the book Richer, Wiser, Happier by William Green, because we realize that at least in the investment world, we think we go in because of the money, right? We want to earn it, accumulate it, invest it, but then we realize that in the process, we're getting a bit wiser because it's an intellectual experiment. And at the end of the rainbow, maybe we can be happier too, or find out what happiness is. He talks about time and freedom, and I feel the same way. And I had so many guests that tell me, first of all, it's not about the money. And second of all, it's some version of the idea of freedom. And the most precious asset that they have, and they know they have, is time. And sometimes it takes half of their lifetime to realize that it's time that matters the most.
I'm connecting time towards, we're getting as non-financial as we can with this comment, but I think it's worth it here. He doesn't just talk about how time is the only limited and the only scarce resource to care about. He connects it back to like the group of friends and the relationships too.
Yes.
And I think this is something on my own journey that I just realized big time was you can always figure out a way to go out and make more money. You can always figure out a way if you need to, or if you want to, or if you choose to, or whatever it is, there's ways to make money. There's not always ways to make more friends. There are always ways, but like you want to reinvest in, you want to keep, I want to let those winners run. I want those friends who I have history with, and there's just a limited amount of time and resources that you can put into new friendships and new stuff. But if you keep surrounding yourself with the people who give you the most, when I say upside, I mean the most upside in this is happy. Like we press record on this and I'm like, I'm excited. I get to spend an hour with Bogumil today talking about these Guy Spier clips because we'll both get equally excited about this stuff. I've been like friend bankrupt before in my life. Like I went through some dark stages of going through some crap. And man, it's so much better when you orient yourself so those two things line up.
I was thinking about the concept of capital, many capitals. G. Hughes, our mutual friend, talks about different capitals. And when I really think about it, the most precious capital to me is the people that I had in my life, have in my life, that played a role and continue to play a role. And Guy does an incredible job building a community. And ValueX is just a platform, an excuse, maybe a permission to bring in people from around the world to share ideas. But he does it in so many different ways, and so many people tell me how Guy has played or continues to play a role in his life. And in one of the clips, we didn't talk about it, but he mentions his father, how his father has cultivated all those relationships with people. He was trying to do something valuable for them. And if you interact with Guy in person, you notice how he wants to put the spotlight on somebody else always. It might be you in the room sometimes when you are least ready for it. But it's not about him. And the last thing I want to add, it's a certain genuine kindness that's a big reason why people gravitate to him. And it's a gift. It's an awareness. I don't think he knows any other way. It's just the way he is. He's going to do something for you without you even knowing about it. And then it comes around and somebody mentions, Guy sent me your book and I really enjoyed it. And I had no idea that Guy sent somebody my book, for example. So anyways, the community that you talk about, I think it's the most valuable asset we can accumulate in this lifetime.
Long kindness, short meanness. That's your trade. Let's go to the next clip. This is about your inner versus your outer self, and it's kind of perfectly aligned. That's why we're jumping right into this next clip.
So I think that their thinking is evolving all the time, and they're updating their models of the world. In fact, we ought to all be updating our models of the world. You know, there's a wonderful piece, of Jewish wisdom, in my case is where I heard it first, in which it's like, the wise rabbis love it when we change our mind, even on important issues, because when we change our mind, that means we're alive, we're growing, we're thinking. We have a growth mindset. We don't have a fixed mindset. So I will come back to that, and I can point out, I'm certain, many ways in which their thinking has evolved, where things that they've done later are things that they couldn't have imagined doing earlier. But I think that what enables them to sit there for as long as they do and take questions the way they do on so many different topics and feel free is that they have collapsed. Most of us, one way or another, end up living our lives with one kind of a mask or another. The face we present to the world is not an accurate reflection of who we are actually on the inside. And what they are is, again, a lesson that I learned from Monish Pabrai. They are, and I'm going to do it with my hands, they're aligned. So if one side is the inside and one side is the outside, most of us are some version of this. But when you become aligned, you can be the same person everywhere. And that makes it easy for them to be in those meetings. And because they're aligned to a genuine version of themselves, they can change their minds, But they also have, and I guess, their values don't change, but their thinking on a whole bunch of topics do change. I think that, I'll give you an example of something that I don't think has changed, is that by and large, Warren doesn't like businesses where there's a middleman. So there is a theme running through so many of Berkshire's businesses where it's well known that he doesn't like to work with investment banks in buying companies. He's always dealing directly. And Geico is a business that doesn't work through insurance agents. And Borsheim's does a lot of business by direct mail, directly with the customer. They don't even come into the store. They call up the store and ask for what they want. And there are other examples of that. But then, I don't remember how long ago it was that Berkshire Hathaway bought Berkshire Hathaway Home Services. They were called different name at the time. They're one of the largest real estate brokerages in the United States. So his thinking evolved on, and there's somewhere he said, I'm actually okay with paying investment banking fees because I know that if I pay investment banking fees, there are deals that I will see that I otherwise would not have seen. So, so their thinking does evolve, but there are some kind of core values and principles that don't change, and they're completely open about these things.
Those wise rabbis, they love it when we change our mind. This is good. I got to hang out with more wise rabbis, I'm thinking. So this whole alignment of inner and outer self, I feel like we've been dancing around this whole conversation.
Yeah.
And whether it's, I think of our friend Justin Castelli and the way he approaches this, but I also just think of the way that if you're running money, if you're an investor, this is how you stick to your strategy, right? This is the things I say I do, but this is what I actually believe. And this is why in bad times, I can stick with what I'm saying. What do you think the investment attachment is inside of this conversational point he's making?
A year ago or 2 years ago, I was in Omaha at the Berkshire meeting, and I was at the airport. I checked in and I sat down, and somebody walked up to me, which happens in Omaha that weekend. A lot of people recognize me and walk up, which I invited. I want people to come up, shake my hand, tell me who you are, tell me your story. And he was nervous, and we talked for quite a while. My flight wasn't coming for a while, and he walked away, and then he sent me a message, and he said, "You're exactly the person I pictured after listening and reading your words."
Oh, that's amazing. That's really cool. That's a compliment.
Right. And I thought, what else would you expect? I don't know any other way. I am the person that you think I am. And listening to this clip, I was thinking exactly about that, how Buffett, Munger, Pabrai, Guy, many other people, including yourself, you are the way you are. You are the math that we get to experience. And I think life is lighter if we are that way. So we don't have to have this polished, ideal version of us for the show or for the profession we're in, and somehow have this very different personality somewhere else. We are who we are, and I don't have to think twice. That's who I am. I'll go out of my way to help a client and spend a few hours trying to solve a problem, and then I have a friend whose motorcycle broke down, and I'll try to help out and find a way to fix it with him. It doesn't really matter. And if somebody approaches me in Omaha at the airport, you're going to see the person you think I am after listening to me for hours.
It's a fantastic visual image. that I'm pairing up with this one too, which makes a ton of sense. So speaking of the two selves and finding that alignment, only because this is a perfect segue right into this next clip. This is about inside versus outside money and risk. If you manage money, you got to hear this clip.
I started with my father basically closing an account at a bank and sending that money over to me. I knew that there's a very, very significant proportion of my father's net worth. And so I was very, very scared. And actually, so I think that if we look at my father was a very, very good in business, an extraordinarily gifted creator of relationships and capacity to bring people along into the kind of situation that would be beneficial for everyone. But when it came to investing, you have these kind of counterintuitive actions that you need to take, which for somebody who's not very powerfully analytically based, so usually with a very strong grounding, I would argue, in mathematics and other kinds of sort of like hard subjects, it's very, very hard to be in. It's in fact, a lot of the actions are counterintuitive. So, I think that if my father had understood concepts of portfolio allocation and risk, he might have taken 10% and said, start with this, let's see how you go. In any case, so he sent me the whole lot. I knew it was the whole lot, sort of like 100% of his liquid net worth, and I was shaking. And so one of the rules that I created for myself was that he'd sent me over, so the previous firm had invested his money in laddered bonds, so bonds with expiration dates going out, with some expiring in 1 year, 2 years, 5 years. And I made a rule for myself that I would not sell those bonds early to buy an investment. My plan was to convert all of those into equities. I knew that long-term equities was the place to be. So I had a kind of like a 5-year program of bonds coming due, which would then provide fresh cash for new investments. But it was very clear to me as well that I wanted to do this in a way that I could take outside money. And so in parallel to taking over this portfolio, I worked on setting up a fund, and I was hugely influenced by Warren Buffett saying, put all your eggs in one basket and manage the basket. And the first couple of investors were partners of my father, or business and former business partners of my father's. I would say that I never sought out people's money, and I was in a very strong position not to have to do that because I could make ends meet with the money that I had. And I've said this many times, but I don't feel I can say it often enough. I have enormous respect for people like Monish Pabrai, who had a very different path. His path was that he sold a business. He had to succeed at running an operating business and selling it before he could move on to investing, which is something I'd kind of started off doing. And I don't think that I have the skills. So I have a much narrower range of skills than, at least in the business world, than Monish does. I don't think that I would have been very good in starting and running a business. Who knows? Maybe it's a luck thing, but that's what I believe. So I had that advantage. And then I would also say that maybe it was wisdom. I wanted to make sure that these new clients didn't invest a huge proportion of their assets with me. So making sure that if somebody invests 100% of their assets with you, they're going to feel about you one way. They invest 10 or 20%, they're going to feel about you another way. I would never want to be more than 10 or 20% of somebody's total net worth. The fund that I run should be 100% of my net worth. That's absolutely right. But it shouldn't, because it just could create a strain in the relationship. I think that having outside investors, we know, and we'll probably get into some of the disadvantages, but there are enormous advantages in that you have to professionalize what you're doing.
I always go back to this Seth Godin quote where he says, doing what you love is for amateurs. Loving what you do is for professionals. And I think about what it means and what Guy says here about it's important to have 100% of his net worth in his fund, but for other people, he doesn't want them to have all their money with him. He wants them to say, like, farm this out, like, take the stress down. But knowing that I have a piece of your money, it professionalizes what I'm doing. I can't be, and this is where I'm careful with that Seth Godin quote, I can't run money as a hobby. And I can't even run it just because this is what I love and only be an amateur about it. I need it to professionalize what I do, which means I have to actually love the process of what I do. How's this whole quote hit you?
there is something special about, finding your calling. And I'm going to try not to choke up because this is my favorite part of that conversation that I had with Guy. And
so good.
I used it as the intro, the first few minutes of the episode when it aired 3 years ago, whenever it came out. And I'm going to explain why. There's this moment when he explains how he was just starting to manage money, and his father basically gave him 100% of his liquid net worth. And Guy explains what it meant to him and how he was aware of what that money represents, which is how I think about my clients' money. I want to know what that money represents to them, and the respect and the responsibility that comes with it. And if you don't feel a touch of fear when you're facing that, I think it's a dangerous territory. He openly says, I was shaking. And just that moment of that clip still gives me goosebumps because I know exactly what he's talking about. If you're taking on the responsibility of managing somebody's family inheritance that might have been around for 5 generations, if you're not shaking a little bit, I would be worried. You're taking on a huge responsibility. And we'll talk more about how he went about it, but it's such a powerful moment of realization. You're managing somebody's livelihood.
It's extra hard. And I think anybody who's in this profession knows that feeling. They know that fear. They know that shiver. They know that tremble. They know that week of absolute panic. Like, I know it's important for us to get away for a while. When my wife and I took the road trip we went, it's like I was basically shutting my phone off and unplugging. But it was like a month of prep and then like weeks leading up to it of getting everybody in my professional circle and the client. Here's who you talk to. If you can't reach me, here's who you talk to. And in case of emergency, to the most trusted people that I work with, break the glass. And yeah, surely. Like, I got a call in a dive bar on a Monday night. My wife got a call from my wonderful partner and assistant, Ben and Lisa. And they were like, this client said this thing and we don't know the answer. But if I don't have that fear, if I don't have break class in case of emergency, if I don't have all that stuff, like, I also love that responsibility. Like, that's a weird thing, isn't it?
It is. I think it elevates the whole experience of what we're trying to do. And the reason I asked that question, managing your own money, managing your family money, and managing other people's money, there are 3 very different experiences on many levels. And it's not just about, he says you become more professional, you professionalize the experience when you're managing other people's money. It's true. There are moments when the client needs you. You're talking about that phone call, and I took quite a few of those phone calls in the last few weeks. As in some ways, it reminded me of March of 2020, and it was the emotional toll that whatever the news flow was doing to people. And they appreciated having me in this open-ended form where we can talk for 30 minutes, 45 minutes. I talked to one client for an hour and a half. And for them, it just felt that somebody's watching, somebody's paying attention, somebody thought about it, somebody has prepared for the last, in my case, 2 decades for moments like this. So yes, the portfolios will respond to what's going on, but we know what we own, we know why we own it, and if anything, we can add to some things that make sense. But I feel like it's almost a gene that we have in this profession where we just know the kind of responsibility that we have. I grew up with 2 doctors in the house, and I didn't become a doctor. It wasn't my calling, but I care for people and I serve people in other ways. And I just couldn't see any other way. And the moment when somebody entrusts their family wealth to me, I have the same experience that Guy has. I shake a little bit as much as I'm excited to help.
That's the son of a doctor and a teacher. I feel it deeply, brother. I feel it deeply. Well, speaking of our childhood, let's dive into this next clip, which is learning from mistakes, which sadly continues straight into adulthood.
So I really kind of did huge damage to my reputation. But I was, at the time that I joined the firm, I was 27, which is still rather old, actually. You want to make your mistakes when you're like 18, 19. But I was old enough to recover from it. And it probably took about 5, 6, maybe 10 years of acting correctly in order to recover it. I think that, so it's like long discursive answer, but I think that for the listeners of your podcast, something that is really, really important and a huge lesson that I learned is that Wall Street, the financial markets are just jammed full of conflicts of interest. And the people who work there are incredibly slick salespeople. They will seek to convince the clients, the members of the public, the regulators, that they are managing all the conflicts. The fact of the matter is, it's very hard to manage all the conflicts. And what I kind of like in conversations with my father, I remember saying that well, I hope that this is not too sort of salacious, fruity language for this podcast, but what D.H. Blair did with the rusty pipe, Goldman Sachs did with a very nicely lubricated object. Either way, you were getting shafted, you know? And so it's just a different way of being shafted. So I learned to see that pattern, and I learned to understand that that was the case. The other thing that it did for me in no uncertain terms is it taught me that there is, and I don't want to call it evil, but there are people who are not ethical in the world, and there are people that I don't want to be around. And so, you know, I'd never really experienced people like that. And they do exist. And the one thing I did know is I didn't want to be around them while I still wanted to be in finance. And the other thing that I knew helped me to leave is that I discovered Warren Buffett, and I knew that I wanted to be like him. So I had something to move away from, and I had something to move towards. And so I think that, you know, that taught me an awful lot. Sometimes, and I mean, here's what I'd say to anybody who's listening to this, who's in mid-career or early career. Mistakes are inevitable. You're going to make mistakes. So be only human. Don't try and be perfect. But the second thing is, learn from those mistakes, because boy, the worst thing you could do is have the damage of having the mistake and then knock out of it. So, you know, in my case, I wrote a book chapter on it, but write reviews, write notes, develop checklists, like go over, rub your nose in your mistakes, as Charlie Munger says, and try to squeeze every bit of value out of your own mistakes. And I certainly think I did that. And, you know, thankfully for me, I think my career's recovered, but boy, did I take a hit.
I don't know if you know John Stoy at all on Twitter or elsewhere. He's another advisor professional. I love how publicly he hates the whole conflicts of interest thing. And he hates it in the sense of he was a former maybe market maker, or at least trader and portfolio manager. And then he avoided the financial services profession, and now he does it, but he does it at a really, really high ethical standard. I just respect the hell out of his approach for it. But Wall Street is so jammed with conflicts of interest. And once you see it firsthand, once you like find that it's there, it's hard to unsee. But just because you can't unsee it doesn't mean you can't do good things with it. And it doesn't mean there's not still good people there. And it doesn't mean there's not still essential pieces inside of this well-conflicted industry that we can contribute to if we set our mind to it. My immediate reaction to that clip, but there's some more thoughts I have there too. What do you think of when you hear about this, learning from your mistakes and the way that Guy explains it?
There's so much in this clip. So one is learning from your mistakes and learning early if you can.
Learn early if you can, yeah.
Right.
But learn late too. Just keep learning.
Keep learning, but the big ones.
Yeah.
If you have to. I like this idea of learning from other people's mistakes, but it's easier said than done. I think some of the mistakes we have to experience on our own. In this case, we're talking about reputation. You know, we talked about respect, responsibility, the other R. There's reputation here. And Buffett often says how you build it over a lifetime and you lose it in a minute. And he has those ideas, you know, would you do anything that you wouldn't want to be written up on the first page of a newspaper that your mom reads? And I think it's a very powerful thing, and Guy learned it and just shared it in his book, The Education of a Value Investor. I think it's very powerful because he talks so much about being surrounded by the right people in his life and being so conscious about it. We talked about community, the people he invites to ValueX and the people that are in his circle of influence. He's very particular about who they are as humans. And I've been very, very impressed with the people I met through him. So he understands the standard that is required to have this lighter, happier life, that you don't have to look over your shoulder if somebody's doing something or not. finance as such is such a massive industry, right? You have the brokers, but you have investment advisors, you have investment bankers, and many things in between. And there are lawyers and accountants involved. They're all different ways to provide the service. Some of them are very transactional, and they kind of have to be, right? You talk to your broker because you don't even talk these days. You use an app or a platform to trade shares. They have something, or they connect you with a seller. They participate in a different way. I think many of them do a remarkable job these days to get you the best price possible, and the costs are limited or none in some cases, right? So I think they all play a role. Investment bankers are needed to bring those businesses to the public market, right? And then how they go about it, let's assume that they're as ethical and as kind and as you can imagine, but just be skeptical sometimes. And then in the investment management side, I love the alignment here because, and I mentioned it to you before, I'm not really selling, I'm buying. I'm buying something that makes sense. And if it makes sense for me, in an ideal situation, it makes sense for my clients. They might be in different position, time, age, and so on. They might be drawing in the portfolio or not. So they might have less or more of it. They may have cash needs and so on. But if a particular stock makes sense as an investment, in the framework we talked about, held over a long period of time, a compounder, certain quality about it, I'm buying it for myself and I'm buying for the clients. I'm buying it for the clients. I'm buying it for myself. It makes sense, right? So I see this beautiful alignment where I don't have to be selling something I wouldn't want to own myself, and it completely streamlines the emotional, psychological, mental process in my head.
I love that streamlining. I think about, I wrote a Cultish Creative post on this. I often think about it as when I learn from the mistakes of others, those are my rules of thumb. And I want to keep those around. The rules of thumb are somebody else screwed something up. And then they told me, this is the way you think about it. But I differentiate between my rules of thumb with what I call my rules of big toe. Mm-hmm. My rules of big toe are things that I have stubbed my toe on. They've been my mistakes. They haven't chopped my head off like I survived to tell about it. They really sucked when I did it. I cursed, I swore, I, dashed around the room in a fury. But I want to learn from those lessons. I want to learn from those rules of big toe. And I'm going to emphasize my rules of big toe over the rules of thumb of others, like always, because that's the unique experiences. This is the stuff that makes us too. And everything you're just saying, I'm hearing the articulation of this is the stuff that makes Bogumil. Like those lessons are actually part of your accumulated value as a human.
And at some point you realize you can't see the world any other way. Like a doctor helping somebody for something they will never bill for or maybe never get credit for. And in some cases, the patient is unconscious. They may not even know that they were helped. It's such a powerful image to me because in the investment profession, there's so many moments where the client might not even know what you did and how you did it. And if you're doing the right thing when nobody's watching, you can never get paid for it and you can never get credit for it. Wow. I mean, that's a very powerful thing, right? You have a true calling that you just have to do the right thing. I met doctors like this. I met lawyers like this. I met investment professionals like this and accountants like that. And when you meet people like that, you want to hold them as close to your circle as possible because you'll need them.
Well said. See, you have that story for it?
I do.
Give me the story. You got me bated breath here.
All right.
Take us out on this story.
So I'll start from the beginning. So I've known Guy for many years, and I wanted to have him on Talking Billions. And John Michaljevic, who runs the MOI Global Events, reconnected us, refreshed Guy's memory that I have this podcast. And so Guy said yes. But funny enough, I was traveling at the time, kind of a backpacking trip for Central America, and he picked a day when I was in the middle of the jungle. And I couldn't say no because I knew that he has a tight schedule. So I said yes. So I flew in, we're traveling, we're surfing, we're staying at this little shack, not really a full-blown house. And I was thinking, how am I going to take a recording from that space? I had my microphone with me, but there was no reliable Wi-Fi. So I talked to the owner, I ran a cable. I took the call. We have a wonderful call. Bits of it that we got to listen today. We stopped recording. I'm going to give a bit of a behind the scenes that is not part of the recording. We stopped recording and Guy says, I want you to come to Value X. And I thought he means next year. He says, no, in 2 weeks. And I said, okay. I'm in the middle of Costa Rica at the end of a dirt road in a little shack, and my prayers were answered that the Wi-Fi worked for the last hour and we could record it, which nobody knows. I don't think he even knew.
Hey, buddy, I might be all out of angels here,
But I said yes. And over the next few weeks, I hopped on the bus and the plane, and I ended up in Panama. It was warm tropical weather, so I ended up buying a big puffy warm jacket and flying all the way to Zurich and then taking a train to Klosters to attend that event. So I might have had even some leaves from the jungle in my shoes when I walked into Klosters Value X for the first time. I wanted to share this story because there are moments when you're called to show up, and I've heard those stories from people when Munger called someone, Christopher Tsai, and Christopher was with his family in Germany at the time. And he hopped on the plane and flew. Germany and California are far away from each other, and he made it to a meeting one-on-one with Munger, which I think he finds as one of his most memorable mentor meeting experiences of a lifetime. So there are moments when you're called to action. Wherever you are, my lesson is here. Say yes and find a way to get there.
if you know it to be true, you know it to say yes. I can't think of a better way to end this conversation. Go watch both. Actually, there's multiple of these Guy Spier conversations between Excess Returns and Talking Billions on YouTube. Bogumil, thanks for hanging out today.
Thank you so much.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. Matt Zeigler is managing director at Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.